You did everything right. You didn't gamble. You didn't chase risky stocks. You didn't blow your savings on something stupid. You are responsible. You kept your money safe, in the bank, in cash, where nothing bad could happen to it. And yet, somehow, you feel poorer than you did a few years ago. Your salary went up. Your balance didn't shrink. But the same grocery run costs more. Rent costs more. Everything costs more. And the money you carefully protected buys less than it used to. Here's the symptom most people describe to me. I'm not losing money, but I keep falling behind. That feeling isn't in your head. And it isn't a discipline problem. You're not behind because you spent too much or saved too little. You're behind because of a specific diagnosable condition, silently affecting your money right now. Today we diagnose it, we trace it, and I give you the protocol. Let's begin. First, let's define the enemy. Inflation is the rate at which prices rise, quietly eroding what every dollar in your pocket can actually buy. In the U.S., it's averaged around 3% a year over the long run. Sounds harmless, right? But compounding cuts both ways. At 3%, prices double roughly every 24 years. At 7%, they double in about 10. The math that builds your wealth can just as easily drain it. We saw this turn brutal in the 1970s. After the oil shocks, inflation hit 11% in 1974 and peaked above 13% by 1980. A loaf of bread that cost about 25 cents in 1970. Over 50 cents a decade later. Prices didn't creep, they ran. Then came the modern shock. June 2022, inflation hit 9.1%, the highest in 4 decades. Anyone holding pure cash watched their purchasing power evaporate in real time. So here's the lesson. Cash feels safe. It feels responsible. But in an inflationary environment, sitting in cash isn't safety. It's a slow, guaranteed loss in real terms. So where does money actually survive? Let's go to the historical record. No projections, no hype, just what the data shows. Stocks. Over the long run, equities have been one of the best inflation hedges there is, but during the high inflation 1970s, stocks struggled badly. Adjusted for inflation, the market was essentially flat for over a decade. So the takeaway is this. Stocks win over decades, not necessarily during the inflation spike itself. Patience is the strategy. Gold, the classic hedge. When the U.S. left the gold standard in 1971, gold sat at just $35 an ounce. By 1980, it had soared past $800, the standout performer of that entire inflationary decade. But don't fall in love with it. Gold is volatile and unreliable short-term. After that 1980 peak, it went essentially nowhere for nearly 20 years. A useful piece, not the whole answer. Bonds. Now the painful one. Traditional bonds are inflation's biggest victim. When inflation rises, interest rates rise, and when rates rise, existing bond prices fall. In 2022, U.S. bonds had one of their worst years in history, with the aggregate index down around 13%. The safe asset and cash lost at the same time. Real estate. A historically solid hedge. Property values and rents tend to rise with inflation, sometimes faster. Your asset climbs, your rental income climbs, while a fixed-rate mortgage stays flat. Inflation actually erodes your debt while inflating what you own. Commodities. Oil, metals, agriculture. These often surge during inflation because they're the very inputs driving prices up in the first place. They were among the few clear winners in both the 1970s and in 2022. So that's the historical record. 5 assets, 5 hard lessons. No single one wins alone. Next, how to combine them. Here's the prescription. 6 parts, each targeting a cause. Step 1. Stop overholding cash. Keep your emergency fund, 3 to 6 months of expenses. That part is medicine, not poison. You need liquidity for real emergencies. But every dollar beyond that, sitting idle, is guaranteed to lose value. The fix is simple. Move surplus cash somewhere that fights back, a high-yield savings account or short-term treasury bills, so it earns something instead of silently shrinking. This single step stops the bleeding. Step 2. Own the asset built to outrun this. Stocks. Over the long run, U.S. equities have returned roughly 10% a year, comfortably ahead of that 3% average inflation. Why? Because when you own stock, you own real businesses that raise their prices when costs rise. Inflation flows through them to you. But here's the honest part. In the 1970s, stocks struggled. Adjusted for inflation, the market went nowhere for over a decade. The ones who got hurt weren't those who held. They were those who panicked and sold at the bottom. Stocks are the cure long term. Step 3. Fix the bond problem with tips. If conventional bonds get eroded by inflation, use the version built for exactly this, Treasury inflation-protected securities. Their principal rises directly with inflation. They won't make you rich, but they're a government-backed guarantee that part of your money simply keeps pace with rising prices instead of falling behind them. A targeted treatment. Step 4. Add real assets. Real estate is one of the most reliable hedges on record. Values and rents rise with inflation, while a fixed-rate mortgage stays flat. Inflation erodes your debt while inflating your asset. The rare case where this condition works in your favor. Then gold. The story's dramatic. $35 an ounce in 1971 to a peak of $850 by 1980, a 2,300% move. But here's the warning label. After that peak, gold fell for 20 years. It is not a magic bullet. Hold a modest slice. Don't bet the house. Step 5. Diversify, because no single asset wins twice. This is the deepest lesson in the data. In the 70s, gold soared and stocks lagged. In the 80s and 90s, that flipped completely. Gold collapsed, stocks took over. You cannot know in advance which era you're walking into. So you don't bet, you blend. Diversification isn't about maximizing your gains. It's about guaranteeing that being wrong about one single asset never wipes you out. Step 6. Mind the 2 silent leaks, taxes and time. Taxes first, and this one's vicious. Here's the trap most people never see. Earn a 7% return in a year of 7% inflation, and in real terms, you made nothing. You simply kept pace. But the tax system doesn't care about real. You still owe tax on that full 7%. The defense is simple. Use tax-advantaged accounts wherever you possibly can. And time. Match the asset to the timeline. Money you need in 2 years doesn't belong in volatile hedges. Money you won't touch for 30 years does. Get that backwards, and the mismatch is exactly what forces people to sell at the worst possible moment, locking in a loss they never had to take. Let me be straight with you about what to expect, because that's what an honest diagnosis owes you. This condition is chronic. It's not a one-time infection you cure and forget. Inflation is the permanent background state of money. The average dollar loses value every single year, forever. So the goal was never to eliminate it. You can't. The goal is to stop being its victim and start moving with it. And here's the most important thing the data proves. The people who got destroyed by inflation were almost never the ones who took measured risk. They were the ones who did the safe thing, sat in cash, fled the market in fear, chased last year's winner at its peak. The damage came from the instinct to hide, not from the willingness to participate. You felt behind. Now you know why. It wasn't your discipline. It wasn't your spending. It was a structural condition acting on the exact assets you were told to trust. That's not a character flaw. That's a diagnosis. And diagnoses come with protocols. So run the protocol. Hold less idle cash. Own productive assets. Use the inflation-protected tools. Diversify across what wins in different eras. Respect taxes and your timeline. And then, this is the part that takes no skill, only nerve. Stay in long enough for it to work. That $10,000 in the safe in 1970? It quietly became worth $3,000. Same number on the bills, a third of the life. The same $10,000 put to work in a diversified portfolio became worth many times more, not by being clever, not by timing anything, but by being built to outrun the condition instead of hiding from it. So here's your one takeaway. Safe and doing nothing are not the same thing. The riskiest position you can hold is often the one that feels the most comfortable. You're not behind because you failed. You were just using the wrong definition of safe. Now you have the right one. If this reframed how you see your money, subscribe to FinancePhysio. This is educational content, not financial advice. Do your own research or talk to a licensed advisor before making decisions.